Hey everybody, welcome back to Anderson Business Advisors. Welcome to Tax Tuesdays, bringing tax knowledge to the masses. I'm one of your hosts, Barley Bowler. I'm one of the CPAs and tax advisors here, joined by Mr. Elliot Thomas.
Hello. Manager, tax advisors.
Bringing tax knowledge to the masses. Tell them what we're doing today, Elliot.
We're going to do a lot. We're going to get through the questions. We'll go through those in a second, but we're just kind of let people get in here. If you want to type into the chat, we got plenty of communication. If you're having problems with visual or audio, please put your messages in there. But if you could tell us why we're letting people kind of roll in here, just where you're coming from. Also, if you have any questions, we have the Q&A section. We got a whole host of people here in the background answering questions. I actually don't have a list today of those people, but it'll be a lot of our CPAs, tax attorneys, EAs, etc. Yeah, we got some Florida going on there. And while they're rolling in here, just want to say a big thank you to everybody who visited us this past weekend in Vegas, Thursday, Friday, and Saturday. We had our big tap event at the wonderful, the wonderful new Durango Lodge, or no, that's the bar, Durango Casino here. It was great to see you, and thank you so much for all your thanks and your appreciation for the show. We really appreciated that. It's great to talk to you all. We're going to have another one coming up in September. We'll have all of our tax advisors, our Vegas tax advisors, hopefully showing up there, so we'll have a little bit more expanded bandwidth. Got a little busy there on some of the tax stuff. But thank you so much. And again, always thank you to our events team, to Kenny and Matthew handling all the electronics and all that stuff that we could never do anything.
You guys.
There you go. Right?
And you guys got to see our main man, our fearless leader, Mr. Toby Mathis, was back at the live event. So great to see him, back out interacting with us here at the live events. So welcome back to Mr. Mathis, and welcome back to everyone here. For anyone that's here for their first time, I'm assuming most of you guys have tuned in before, but for anyone here for their first time, again, post any feedback for us in the chat. If you can't hear us, can't see us, shout out where you're tuning in from, all that good stuff. Post any questions to the Q&A. This is Tax Tuesdays. We're going over your questions. You submit these questions. Elliot reads every single one of them. I watch him. He really does. He reads through every single one. We pick out questions that will hopefully be the most beneficial to you, plus can try to cover a good bit of ground here, provide the most value to you that we can here in this hour and a half. So we got events. Big thank you for showing up to the live events. More live events coming up, guys. For those of you that have attended, you know that it's a lot of fun. It's a lot of work. A lot of synergy. You can meet with your fellow entrepreneurs. Great time. Plus, get to meet the partners, talk to your tax advisors there. Love getting to meet you guys one-on-one. So keep an eye out for the more live events coming up. More coming up.
September, Vegas, probably December, Dallas. We'll have the exact dates hopefully soon.
Yep, so when we get into that Q4 tax planning, right, we'll put the tax hats on, come to the live events. We'd love to see you guys there. Now, that said, we got a bunch of questions to go over. Really covering the gamut today. We got structure stuff, plus we're going to crunch some numbers. Really try to keep you guys engaged here. I know we're talking taxes here, but we want to go over the finer details. Make sure we're getting every dollar deduction we can. With that said, should we read through the questions here?
Yeah. One thing that's not on it: rep status.
Oh yeah, we left that part out. Have you guys ever heard of that one? Right? Real estate professional status. So obviously, the majority of our clients are real estate, small business, stock traders, right? You guys know the deal. So we obviously focus on that rep status. You'll have material participation a lot. Today's shifting gears a little bit, but still keeping it real estate, small business, always sticking to the bread and butter here. So that said, we'll go over the rules here. Ask live Q&A. Yep. Email your questions, right? You guys, mostly for anyone that doesn't know the drill here, Tax Tuesday at Anderson Advisors. Submit your questions. We go through and read them all. We go through them live, and this is purely for your benefit here, just offered as part of the service. We'll push you to become a client if you need specific calculations or specific guidance for that matter. Right? This is a general forum. We're going to go over a lot of topics. One thing I like to suggest is when you hear us going through this stuff, if you're like, oh, hey, that applies to me, right? Just kind of whatever the topic is, you can submit a Platinum Portal question for more detail if you're a Platinum client. A lot of ways to get in touch with us for additional guidance, right? Fun, fast, and educational. Should we hop right in?
Let's do it.
All right.
Go through the questions first?
Yeah, sounds good. Start us off.
What is the best way to reduce my income and my self-employment taxes? I'm single, a handyman / contractor with no dependents. I work solo, no employees.
Nice, bunch of good info there. Question 2, I have an S-Corp LLC taxed as an S-Corp for my property management and business consulting activities. I'd like to provide me and my spouse's health care through the LLC. What's the best way to go about this? Great question, common question.
The self-employed limited partner exception, something
What's
that
that?
we talk about all the time, not. Please talk about this topic. We will do just so. It is a highly fact-specific test, but if you
That it is.
qualify, it can result in significant tax savings.
Perhaps. We'll find out. How can one start a business? LLC or C-Corp or kind of any of the mixture of those, right? And the ideal state of incorporation, and hold those shares in a Roth IRA. Tricky.
What types of taxes and tax reporting will be involved if I begin investing in tax liens?
Yep, some of you guys are doing that, tax liens. What are the rules for capital gains taxes on the sale of a house? Good question. When the profits are used to pay cash on the next property. Okay, I bought the house for 130K, put about 600 to 700 into it, sold it for 1.1. We got some numbers here. How do I figure the capital gains? Definitely going to go over that.
I am taking my primary home and turning it into a rental for 1 to 2 years. How do taxes work if you wanted to 1031 a portion of the gains? The purchase price 10 years ago was $430,000. I actually changed that. They put in $400,000. We'll see why. I lived in it for 8 years and rented it for the last 2 years. Sales price was 1.4. I am single, taking the $250,000 exclusion and 1031 the remainder of the $750 into a new property. Can this be done? The annual depreciation calculation there.
All right.
We'll find out.
Combining a couple big code sections there. Related, under a 1031, taxpayers must select 3 possible real estate properties, and we'll find out that's not necessarily the case, within 45 days of selling the original rental property, right, the relinquished property. Can these selected properties be changed before the 180-day deadline? We have these very strict timelines on the 1031, right? Due to some events that are perhaps out of our control, right? Finding a better property, or maybe the property was delisted. Do we have any flexibility on that? We'll find out.
I have a boat to donate.
Oh, that's it. We're out.
Exactly. Every time we talk boat taxes, they don't mix well.
Joke.
I have a boat to donate to charity. Is it true that I can make a donation, a $5,000 donation, without having a certified appraiser and claim all my taxes as a direct write-off?
Good question. Few moving pieces there. And finally, kind of a good just catch-all, right? What are the ways we can avoid probate? We talk about legacy planning, wealth building, a couple specific issues we definitely want to stay focused on there. You guys know the drill. Toby's YouTube page, well over 1,000 videos now. Check that out. Of course, tons of information on tax planning, interviews of captains of industry, just great industries. Yeah, just keep in touch. I'd go over the different aspects of it, but I really like the interviews that he's been doing with kind of, I guess, what we call blue-collar type worker jobs. There's just so much opportunity out there, and I really like how Toby's exposing that. Please subscribe. Tons of good content. As you guys are aware, Clint focuses on the asset protection side. Bunch of good content there. Make sure you check that out. And got an event coming up here.
We do a Saturday, July 12th. That's going to be our online virtual event, as well as the 19th, those 2 Saturday events. Again, I think the next TAP event probably will be our Vegas one in September, and then followed by Dallas in December.
Nice.
More details to come.
Yep. So these are virtual events, right? Live, tune in. Let us know if you have any questions about that. You can register. Probably got register links right in here in the chat if you need them.
Great way to watch from the comfort of your own home.
Right. We can't deduct the the flight and lodging, but
right?
Whatever. All right, guys, we'll hop right in. Ready to get to some tax questions. Make sure everybody's caffeinated here on a Tuesday afternoon here.
I think it's Tuesday, right?
So, what is the best way to reduce my income and self-employment taxes? Self-employment taxes, that can be a big one, big burden, huh? I'm single, a handyman, I'm a contractor with no dependents, I work solo with no employees. I love this. This is a good blank slate, right?
It is.
We have a business and we got a whole bunch of options we can look at here, but where would you like to start, sir?
Yeah, what we're going to do here is start with structure, that is formation. How are we going to, what kind of business are we doing this in? And by that we mean the LLC. And many times we talk about this, Barley, over and over with clients. What is it special about the LLC?
It doesn't, by default, have a tax designation.
Exactly. What can it be?
It limits liability, but it can be disregarded, or a partnership, or a C-Corp, or an S-Corp.
So we're going to use that kind of mess of different taxations to determine what's best in this situation. Now, of course, it always depends. If you had too much money or not enough, how can you have too much money? But if you make a lot of money, some of our answers will change.
More money, more problems.
Right, exactly. But there are some things that we can kind of put into maybe just the regular, normal situation. Yeah. In that case, we're going to look at What if we're sole proprietorship? We call it Schedule C. And we're going to see what happens if we're an S-corporation. We're going to look at those two and maybe briefly touch on some of the others. So I think now we're going to use our pen, yes?
Oh, yeah, sure. And I just want to throw in there, remember, guys, when we're talking about, so right off the bat, what's the best way to reduce my income tax? So I'm assuming right off the bat, you're potentially a sole proprietor reporting your business on Schedule C. What's unique about that? 100% of the net income is subject to your ordinary tax plus that additional 15.2 or 3 extra employment tax, right? That can be, we consider that an excessive tax, especially on the 100% of net income. So we're going to run through an example here to crunch some numbers. Let's show what we're doing.
So we're just going to go with what if we had $50,000 of income from this business, and what if we were Schedule C? So if we do that, we take, first of all, the SE tax, self-employment tax, and that's 15.3%. So if we took that 50 times 15.3, that's going to equal $7,650.
You're good with numbers.
Right? Already a huge amount of tax right there. Then we're going to have the taxable income. The taxable income is on the whole 50 amount. That comes out to be $11,000 even. I went with a 22% tax bracket just to put us somewhere in the middle.
So TI, we got 11.
11,000 even.
11 even.
For a total of $18,650. And there's not a whole lot, we could do like maybe a home office and things like that, but we're not going to do that on the other one. We're going to take advantage of things that it can on the S-corporation, that is. But the home office kind of just, we're going to say it just washes out, so I'm going to ignore that. So now we're going to go with an S-corporation, which is probably what most people would want to go into here.
Right, active business, that'll be a good general recommendation.
Yes, sir. Same 50 of income. But now, because it is an S-corporation, we can do a little bit more. The one thing we can do that we wouldn't do on the other is our 280A meetings, just the Augusta rule. And I went with a $500 a meeting times 14. That gives us $7,000. So we do 50 minus our 7. Now we're at a net $43,000. Before we even start the tax, we're already way ahead of the Schedule C. You'll see. We take that. Now, something special about our S-corporations, we have 2 forms of income. One, the reasonable wage. We've got to pay a reasonable wage, W-2, and then we got to pay tax on a distribution. Reasonable wage, subject to all the taxes that they could throw at us. So half of 43, we went just down the middle. If we do half of a wage, that's $21,500 for our reasonable wage on their S-corp.
Because remember, if this was the C-Corp, that whole 43, that'd be your net income subject to your ordinary tax and employment tax, right? But over the S-Corp, we can pay a chunk of that as a reasonable wage.
But here, we only have to do the $21,500 times 15.3. That's our employment tax on it. It's going to be 30.
Oops, did I mess up? I got net 43K.
And here's going to be our SE tax.
Oh, yeah, SE.
3,289, approximately.
Okay.
And then our taxable income, again, on our paycheck, is going to be 4,730 at 22%.
Okay.
And this, again, is just that first branch, reasonable wage. That's our paycheck. Then we have the second branch, distribution, but that doesn't have that employment tax that Barley was talking about at the beginning. That's what we is excess tax that we don't need to pay.
Right.
We're only going to pay
ordinary.
Yep, exactly. The taxable income at 22% on that other half, so that comes out to be 4,730 as well. Same 21,000 times 22%. So we got another 4,730. We add on there. When we add that all up, the total tax for our S corporation is $12,700, and we'll say $50. So our difference comes out between the two about $5,900, approximately $6,000. That's the difference merely by changing tax form, going from the Schedule C, which, by the way, I think the IRS likes to look at a little bit more.
Yeah, high audit risk, absolutely. And similarly, near zero audit risk at the corporate level, minimal audit risk.
And even if they do look at it, even when the statistics show that they usually don't find a whole lot, when they do go to the S corporation for an audit. So. Sure. We look better for an audit percentage. We certainly have better deductions that we can take advantage of, and certainly don't have to pay all that employment tax. Again, that Barley was pointing out at the very beginning. Employment tax, something that we have a lot of control over to limit. So $6,000 approximately of difference. That's what we're going to suggest in this situation. And this would probably go up to a much higher tax bracket. You'd probably have to make a lot of money before we talk about the other form, say a C corporation. Of course, we're not going to have the partnership because we're just a solo, so we don't have another partner. So it just leaves us with an S corporation. Maybe if we wanted to have a medical reimbursement plan, that might be a thought, just something to think about. But absent that, this is normally what we do. Take a Schedule C, get rid of that high audit risk, put it into the S corporation, and there you go.
And notice this is with 50K income, right? 100 income, 150. These are, you know, the numbers. If the more income to make, the more pronounced the savings will be switching to an S-Corp for sure.
And we're going to see more about self-employment tax, our good friend, in some of the future questions here coming up.
So I hope everyone can read the handwriting there, but on a just 50K of income, not that that's a small amount of money, but you know, considering what we're bringing in as total earnings, that's still $6,000 just on 50K income. And so that's right around where we're going to be looking to incorporate anyway. Once we make 30, 40, 50,000 net income on Schedule C, that's when we'll look to incorporate to an S-Corp.
Exactly. Save $6,000 by just tuning in today.
All right, great work.
Good stuff.
All right, let's see if I can get this erased and we'll go back to the basics here. All right.
So I guess we got that one, I think, handled.
No employees, that's important. Boy, we're going to talk about this in a moment too, but no employees, set up an S-Corp. You now qualify for solo 401k. Now that's when we get into the big fun numbers, right? Coming up. All right. I have an S-Corp LLC for my property management and business consulting activities. I'd like to provide for me and my spouse's health care through the LLC. What's the best way to go about this? Great question. We get this a lot too.
We do.
Because healthcare can be confusing.
Exactly. So on the S corporation, we have rules. If you're an over 2% shareholder or owner, which we do have here, presumably this individual owns 100% of the S corporation, or their spouse does, or even if it's 50-50. Nonetheless, the way we would treat this, we would have the S corporation pay for the premiums. We can do that, have it pay for the family premiums. Even if the other spouse isn't an employee, you can handle your the employee spouse's health insurance premiums, those of the spouse and dependents, so we can throw that all on there.
Yeah.
One of the catches to it, though, we got to call it ordinary income. They're part of their wage. So in other words, if they're taking a paycheck, and in this case it's an S corporation, we just talked about having a W-2 paycheck, the reasonable wage. So here, let's just say it was $10,000 for that medical premium for the family. We would add that on, but that portion, because it's strictly for the health insurance, we don't have to add on self-employment tax. So we're just increasing the taxable income to the wages.
So it gets added to your W-2, but not subject to that additional employment tax.
And now when they get that W-2, they get that W-2 from their S corporation come tax time. Where are they going to put it? They're going to put on their 1040. On line 1A, is where you're going to see your box 1 W-2 wages. So you'll have that with the additional $10,000 on it, not subject to employment tax again. And then on line 17, you're going to have what we call adjustments to taxable income. There we get to take all that back, the $10,000 back. So what we've done, by having a deduction at the S-Corp level of approximately, let's say, $10,000, remember in our question we just went over, we were able to reduce our taxable income by that 280A. We moved from 50 down to 43. Well, now if we had $10,000 of insurance premium, we did the same thing, 50,000 down to 40. What are we doing? We're lowering the amount that we have to pay as reasonable wage. I mean, we're going to save on even more self-employment tax, and we haven't even touched the 280A yet.
Right.
So if we'd put that back on the previous question, we're going to see all kinds of savings and a far larger distinction here. So I just throw that out there that that's how it would happen. You put it into the wages, and then we take it back out as an adjustment on our Schedule 1, or is it Schedule 2?
Yep,
I get them mixed
Schedule
up.
1.
Schedule 1.
Yep.
And that's how we're going to handle it for our S corporation.
Yeah, on that Schedule 1, I think it's self-employed health insurance deduction. You'll notice that Schedule 1 should look pretty familiar. That's where your HSA deduction will show up, your IRA deduction will show up there. I think you got a couple other common ones in there.
Speaking of healthcare, S corporation, you just said it, HSA. We got some stuff we can do there too.
Yeah.
So we got all kinds of opportunity. Just kind of leading off the fact that we're talking about healthcare there with the premiums. Remember, we have an HSA. You can put into that, get a deduction. Barley and I put some numbers together here. The family plan for 2025 is $8,550. That's how much you can put into it. You get a deduction. Single, $4,300.
No restrictions on that either, guys. You don't have to have earned income, which is very common for these deductions. There's no AGI upper or lower limit for this necessarily. There's no upper limit really is the main concern there. You get that HSA deduction every year as long as you have that high deductible plan.
Exactly right. And that high deductible plan, speaking of which, we did a little research there. It's $3,300 for the family plan.
That's the deductible limits.
Yep, on the plan itself.
Yep.
And then $1,650 for the individual. So just carrying off the idea of how to handle the insurance, just remember in that business you could probably throw out some HSA contributions, get a deduction, and as we've talked about many times, so we won't go too deep into it, remember that just keeps growing.
Yeah.
If you don't use it, it keeps growing tax-free.
It's like an IRA, right? The growth is tax-free, and that's a big deal. Hold the plan until after retirement, no penalties on the withdrawal. All the growth is tax-free, right? That can be pretty significant. You can turn it into a self-directed HSA. You can pass it on to your heirs. A lot of options there. It's actually a very flexible kind of tool there. A lot of people really like that, myself included.
2 questions. We have lots of tax savings already.
Right. This field of dollars flowing. All right, what do we got next here?
The self-employed limited partner exception. Please talk about this topic. It's a highly fact-specific test, but if you qualify, you can result in significant tax savings.
Now, guys, we joke around because some of these get a little obscure, but it's just these are great questions. I just want to bring that up. We're not trying to be flippant here.
No.
Some of these are just such, some of the tax code stuff is so obscure, and like Elliot's going to go into this. I don't have a lot of experience with it, but we can talk about in the 70s. We could look at it one way, and then today we look at it a different way. But
yeah, we got a lot, that kind of hits on this. And as Barley mentioned, back in the 70s, well, remember it was a different time. Most of us, maybe many of us weren't here. But at that time, it was a real goal, believe it or not, to pay self-employment tax. People wanted to pay it.
Right.
Why would they want to do it? Because Social Security was considered such a great deal.
Yeah.
So many people would maybe be a limited partner, and they say, well, yeah, I'm a limited partner, but I did enough work because I kind of like handled the hiring and firing, or I did the marketing. So really, I should probably pay self-employment tax on that. They'd want to be charged, so it would go into their Social Security, and they'd be able to take advantage of it, later on. Clearly, if we've seen anything, that is not the case today. Things have changed. But back then, the IRS said, well, look, we don't want people taking advantage of the code like that. So we're all the way on one end of this spectrum where they say, no, we're not going to let you. The IRS is saying, we're not going to let you pay self-employment tax, okay? Whoever thought that argument would come up? Now, fast forward.
We're not taking your money.
Yeah, we refuse. We don't want your money. Now we get to the modern day, what goes on here, all the time we're fighting this. The idea is that I could be a limited partner, and I apologize, we should have probably started what a limited partnership is. Limited partnership is simply a partnership where you have what's called one general partner or more. They have 100% unlimited liability. You usually make that a corporation. And then it has all these other partners that are just limited. They're limited in their liability just to what they put into the partnership. So now people come in as a limited partner, limited liability, but now today what people are wanting to do is have it in their active business, do some work, but not get charged with the self-employment tax, that extra 15.3%, 12.4% of which is Social Security tax, on approximately another 2.9 that is your Medicare tax. And so these are all amounts that they're trying to avoid these days. The idea is how much activity can I do as a limited partner and not have to pay that self-employment tax? Well, there's a lot of tests, a lot of going back and forth, a lot of court cases have happened.
A highly fact-specific test?
They had, and then approximately around 2023, a case came in, maybe early 24, that really set and won for the IRS how we're going to look at this, or everybody's projecting, because we don't have the answers yet from the IRS, how they're going to interpret this. But it's going to get real strict. The IRS is kind of probably taking hints from the courts that they're allowing a lot of leeway to the IRS on this. So we can expect that 15.3%, that self-employment tax, to really get hammered against a lot of limited partners who do any kind of activity. So that could be, again, in the hiring and firing decision making, if you're doing the daily work there, if you're doing any kind of management or things like that, marketing, what have you. These are areas, if you're doing any real activity, you probably don't want to go down this route. There isn't any bright line test, but the more activity you do, you're probably going to get hit. It used to be they would look to state law, and they still do, and they look at a list of maybe 30 different types of different activity. Oh, I fired somebody or I hired somebody. Was that enough? Maybe not. But after this last case, again, that came out in 23, 24, it's really predicted that the IRS is going to hammer down this. So really, if you want to save on self-employment tax, jump back to the S-Corporation, which we started off on.
Yeah.
That's your best bet for saving on self-employment tax. You can roll the dice. You can go ahead and try to have a little bit of activity in there. But probably the IRS is going to tag you because they're feeling very emboldened by some of these cases. So we'd recommend the S-Corporation. But that's the whole the whole to-do about the limited partner exception.
Right. And we've got clear guidance on using S-Corps and C-Corporations. You want significant tax savings. You know, an S or C-Corp with a qualified retirement plan and all the accountable reimbursements. I mean, that will produce significant tax savings, you know, at least for kind of your active business.
Great point. And as we pointed out all the way back when Barley was doing all the calculations, you got extra things like a 280A we could throw in there, administrative plan. We didn't even bring that up. Accountable plan, all kinds of things. What we got in the accountable plan? What we got going on there?
Yeah, that's a great question, because when we look at this, when do we get a benefit for being reimbursed from the business? And the example I use, if the business needs $20 worth of office supplies or something like that, you just buy it on the business credit card, right? There's no benefit to you paying $20 getting reimbursed. On the other hand, things like cell phone and internet, for example, that's a great example. You're paying that bill, you know, you're paying 100% of that bill. You're getting personal benefit out of it. You're using your cell phone and internet at home. Your family and friends probably come over and use it as well. But because you're required to have those tools to perform your job duties, you can be reimbursed for those at 100%, tax-free. Cell phone, internet, home office, that's like a percentage of your living expenses, reimbursed, tax-free every year. Right? Wash, rinse, repeat. This we have plenty of clear IRS guidance on.
No, that cloud.
Right, no cloud, right? We have an accountable plan for reimbursements. We sign that, add that to our documents, and now we can start taking reimbursements. And then again, couple that with a qualified retirement plan, like a solo 401k or something. That's kind of getting to be a pretty unbeatable structure as far as taxes are concerned.
Absolutely.
We just avoid partnerships for active business generally. I mean,
right. I mean, there's nothing wrong with doing them. You know, we do it with active real estate all the time.
Sure.
You know, there's a time and place for them, but don't try and save on self-employment tax. I really don't recommend it.
Right.
And I think part of that is how much are you making? How much is the distribution to that limited partner? If it's $100 grand, starts getting to significant amounts, the IRS is going to move every rock and stone that they can to try and hit that, tag it with that 15.3.
Yep. All right. Any questions related here? Good?
I think we're good.
All righty. All right. How can one start a business, LLC or C-Corp, and ideal state of incorporation, and hold those shares in a Roth IRA? Well, this is a great and kind of scary question. I get a little nervous when this comes up. Because can we do it? Yeah, we can do it, right? There's ways of having, you're using a rollover business startup. We're going to talk about it, having the retirement plan own the shares only. But it makes me a little nervous. What do you think?
Well, it should make us real nervous with the Roth IRA because we can't do it there. The simple answer is no, we can't. But as Barley pointed out, can we have? Well, first of all, why can't we? We can't have an operating business owned by basically the beneficiary of the retirement plan. We can't have that mixture. So in other words, what would happen here is you'd have your own S corporation or C corporation being held by your plan, and then you're working for that business. That's not going to work, especially that'd be a prohibitive transaction, so we aren't able to do that, especially in a Roth IRA. Now, we do have something where we can introduce maybe under a solo 401k the concept of ROBS, or rollover business startup. That's a little bit more unique, and we have seen this come and go in popularity. But what basically happens is, let's say you have your old 401k from your previous job, you set up a brand new C corporation. Now that C corporation sponsors a new plan, solo 401k. We roll the funds from your other retirement plans, other than a Roth IRA, because it can't roll over, but we move all the others into the solo 401k. So we have all this cash now sitting in that new solo 401k, again, sponsored by our new C corporation. Our solo 401k goes and buys all the shares of that C corporation. It now owns it. And you can work for that C corporation. So now all of a sudden, you do have a business, startup business. It has to be an ordinary C corporation, meaning shares. but it's now owned by your plan. But yes, you can be an employee. Now, can you take a wage? Could you do a 288? Could you do the accountable plan that Barley was talking about? Not so fast. We have to make sure that that business is starting up and actually bringing in money and funds, because the plan is now the owner. The plan, we got to be careful of having us personally benefit, as opposed to our plan. So in that case, once the plan, or excuse me, the business is up and off its feet and making money, well, then it probably could pay a reasonable wage and things like that, do some of these other things. But you really got to make sure that the business is doing very well to justify that. Otherwise, the IRS can come in again and shut the whole thing down for being a prohibited transaction. But that's the Roth section. But we can't do that with a Roth IRA. A Roth IRA, unfortunately, cannot roll over into any other plan. It's not allowed to roll its funds over into a solo 401k, even if that solo 401k has another Roth component.
Roth component. That's
can't do it.
Yep.
It's so frustrating. So in this case, no, we cannot start a business that we're going to be in, operating, et cetera, and have those shares held in the Roth IRA, unfortunately.
And just to quickly touch on this, generally the best state to incorporate your corporation will be where you live. If you plan on putting yourself on payroll, setting up a retirement plan, all that stuff, those will generally be required. I think if you want to put yourself on payroll through your corp, you have to set it in your state of residence. But generally speaking, that it'll be your state of residence there. There could be other situations there if you're using it kind of for offhand management.
One more thing, just real quick on there, because when we see a question like this, again, we didn't have any, no mention of our ROBs or anything like that. So we kind of go with what we think people might be really, maybe they've heard something. Another thing I would add on here is the idea of having a C-Corp shares, if it's a newer business, having it in my retirement plan. When might I want to do that? Well, maybe if it's a new startup or something like that, a C corporation, I might want to have my shares put into my plan so it would grow. If I had the next Bitcoin or the next, is it Meta? Is that
Google
what, Facebook and all that? Yeah, any of those big high techs. If that's the next thing, well, maybe I do want to have those kind of shares, startup shares in my plan. So we just kind of, that's why we got into the ROBs and things like that. So I point that out, that would be good, just not a business that you're operating.
Yeah, and to build up what Elliot just said, we are, not trying to throw things that are invaluable at you, but throwing a bunch of different stuff at you so that, again, hopefully, if this applies to you specifically, right, submit us a Platinum Portal question, ask for more detail. We can go into a lot more on the weeds on these topics, guys, right? But certainly, please identify this if this is something that is unique to your situation. We can give you a lot more guidance. All right, moving on.
Yes.
Excellent. What types of taxes and tax reporting will be involved if I begin investing in tax liens? That's when somebody says I owe money and they put a lien on my property, right?
Right, exactly.
And
so,
some of you guys are into this, so let's break this down. Yeah.
Yeah. So the tax lien, it is just that. Most often we're going to see this with property taxes. Some state and local government.
Back taxes.
Yep. They put it, you owe the property taxes. So most often we're going to see that coming. It's not that the federal government couldn't put a lien, and they can, especially if you owe on income tax and things like that. So there's any assortment of taxes that could be involved. But the premise here is the same. Again, usually dealing with the state and local taxes, county level, something like that. We have that tax. It didn't get paid. The government, the local government wants its money. So they can go out there where investors can go and pay off that amount of tax and basically take over the lien. They buy the lien, perhaps at a discount, perhaps for a little bit more. But whatever it is, that investor puts in themselves in the shoes of the government as being the recipient of that tax lien. So now homeowner starts to pay the investor, okay, if they want to start paying. It can be a lot of money. There's a lot of interest. Some states have up into 20% on these type of things on this note. That's a lot of interest income. So it could be very profitable to get into this type of investment. However, as we know on homes and in any other asset indeed, you can have all kinds of liens against it. It could be what if you put a new addition onto that house as a homeowner and you had a mechanics lien? The carpenter came over and didn't get paid fully, so they put a mechanics lien on it. There could be all kinds of liens on there, or even the IRS or something like that. So you want to be very careful in investing in these to make sure you know what liens are there, so we don't get hit with a bunch of other liens, or maybe liens that are ahead of ours. So all things we want to be careful and note. Nonetheless, if you have that tax lien, the payments are coming to you theoretically, and if it gets paid, there is a redemption period often on these things where the homeowner has so often, maybe a year, maybe a two, to finally get caught up, pay that lien off, get themselves clean, and then they would take back the house. But the idea is you've had 2 years of 20+ interest on your investment, so that it can be a very profitable investment. But what if they don't pay? If they don't pay, well, then we can go into foreclosure. As the investor, you take over the house.
Right.
So we either have free flow of money coming in ideally, or we have a new house. And that's kind of the basics behind the tax lien. Again, what tax is involved? It's going to be the property tax most often that we see, but there could be others. But that's usually the general play there.
And a lot of these regs will be county to county, state to state kind of guidance or regulations as well.
We talked a little bit about, like here in Clark County in Nevada, you have to go down to the courthouse. They have the auction where they auction these things off. So there's a lot of different ways of doing this. And every county pretty much has its own rules. Even with the state of Nevada, the various counties have slightly different rules, is my understanding. So you just want to really make sure you understand the area you're going into this. Make sure that you're clean on other liens or anything that might be on the home. But that's kind of the idea. Another question we get asked a lot when this does come up is, okay, Elliot, I take over the house. All right, I finally got it. They didn't meet the redemption period. I'm now the new owner. I claim it. I'm going to use it as a rental. What's my basis? Well, your basis, let's say the house is a $1.2 million fair market value house. That's not your basis. Your basis is simply what you paid. That's going to be the tax lien amount you paid in, maybe some ancillary expenses with that. So that's what we would use for our depreciation. Maybe not as beautiful situation there because we got a very low basis, but hey, you got a $1 million, something house, could be worthwhile.
Right. So what types of taxes report kind of depends on the outcome. You'll probably just get some interest income. You may end up owning a house. Right, those pretty much those are your two options. You'll the tax reporting will just be treated accordingly. The interest income one, that's pretty straightforward. You just got to make sure you have all the right paper and all that stuff to substantiate your transaction. Anything else on that one?
I think we're good.
Investing in tax liens. Yeah, I know you guys. Some of you guys do that. We have people that invest in tax notes. Yeah, we've got people that invest in all kinds of different real estate things. All right, guys, how we doing? Stretch, take a breath. Going through taxes. Put on the tax hats, drink your coffee. Tax and Asset Protection Workshop, just to remind you guys, live events, make sure you we got a thumbs up. We're still alive out there, thanks team. Tune into these live events, guys. A lot of fun from the comfort of your own home. I know tax and asset protection, it's repetition. I studied this stuff. I still learn something new every single day because you just have to hear this stuff over and over and over again. So big props to you guys. Commend you for taking on the challenge.
Here comes the love.
For taking on the challenge of learning legal and accounting all at once. My wife's an attorney, and I'm a CPA, so you can imagine our dinner table conversations. But I can't imagine learning both all at once. I'm still wading through the tax code, but this certainly helps, guys. Clint and Toby are such great teachers, right? There's just something when you've been doing this for 30 years that the information kind of just starts to crystallize and you can convey it to people in a way that just works. As you guys know, it's nice to get that from our partners, real experience out in the field. Oh yeah, we can do this right now. If you guys want, I think this QR code is active. Maybe you can let us know in the group chat there, but we can set up, if you need to set up we are live QR code, thank you, Patty. You can set up a strategy session right now. If you want to get the ball rolling, get this process started. We're only halfway through the year. Don't wait till December 31st. Click on that link and we can start talking right away. More taxes. All right, keeping it going.
All right, what are the rules for capital gains taxes on the sale of a house when the profits are used to pay cash on the next property? I bought a house for $130,000. Put about $600,000 to $700,000 into it, sold it for $1.1 million, pay off a mortgage of $500,000. How do I figure the capital gains? So I think we need some calc here. Yes, yeah. Please.
All right, what do we got?
So first of all, we have the original purchase price, $130,000.
Purchase price, $130K. Okay.
We put in those improvements. We always talk about $650,000.
CapEx. So $650K, so put a lot into it.
So our basis at that point, $780,000.
Basis, right? Remember, that's just what we put into it, right, guys? That term is real common with stock. What's your basis in the stock? It's what you paid for the stock. What's your basis in the investment? It's what you paid for it. And we'll, a couple additional terms to that before. Adjustable basis, depreciable basis.
And then we sold it for 1.1, our sales price. from which we're going to subtract our basis, our adjusted basis, which we just determined was 780, and that gives us a gain of 320.
Taxable gain, 320K. Okay.
So first of all, that's how you determine your capital gains on this. Now,
Purchase price plus improvements equals depreciable basis.
and if we had used it as a rental, which we saw earlier on, we're going to have that depreciation, so we would subtract that out. But we don't have that going on here right now, at least not in the facts. And then we mentioned the mortgage, $500,000. That's a kind of a red herring, if you will. It doesn't mean anything. You paid off the mortgage, that's fine. It doesn't have anything to do with the calculation of the tax.
Right.
Simply purchase price, less basis, or adjustable basis if we made improvements and depreciation gives us our gain.
Yeah, you could owe $1 or $1 million. It won't affect the taxable gain.
Correct.
Determined by adjusted basis.
Exactly. But if we had any depreciation, again, we would subtract that out. And if we did have this gain, let's just say that we had rented it and we had for the last year and we had $20,000 of depreciation on it, or 320 gain, then that first 20 of our 320 gain would be subject to the depreciation recapture. If it was just an ordinary rental, we hadn't done any cost seg or anything like that, it'd be limited to 25% tax. A little bit outside of what we're asking, but that's how you would figure out your capital gains. Again, in that sample, we took away 20 for our depreciation recapture. The other 300, just your ordinary capital gains, 0, 15, or 20% brackets.
Right, so at this example, right, we'd have 300 subject to the capital gain, typically 15% for most of us. And then 20K subject to that higher tax rate of 25% for the depreciation recapture. 20K here. Kind of ran out of room there, but you guys get the deal.
Perfect.
Yep. So 25% here, typically 15%, maybe 20% on the 300.
And to the real question, let's answer that. What happens on the cash that they put towards the next property? Nothing. It doesn't mean anything. That's just your down payment. But it doesn't change anything to do with the original amount here. Where we sometimes roll into that is when we start getting into maybe a 1031 exchange, which we're going to see in the next couple of questions to kind of roll over. But at this point, we didn't do any of that.
Good question here.
Do you deduct sales expenses from the gain? Yes, it will be taken from the sales. Actually, we don't say from the gain. No, it's actually going to come from the sales purchase price. Would be an expense thrown in there,
Right.
Which then determines
Commission,
the gain.
selling expenses, all that stuff.
Yeah.
Yep.
Really what you're getting at is, do you get to deduct it? Yes, you
Yes,
do.
yeah.
Yes, you do.
Yep. That's right. All right. Well, let's see. Did we cover that one?
Mm-hmm.
All right. Capital gains, pay cash. Oh, yeah. Profits used to pay cash on the next property. Very common question, guys. So I sold a property. I got 100K of income from that. So if I go reinvest that, I don't have to pay tax on it, right? Well, no, we have to pay tax on the income. Then we can reinvest it, unless we use that 1031 exchange. Obviously, very common for real estate. So that's just a very common question, right? We have to pay tax on the income, and then we can deploy that income wherever.
So on this one now, we're going to actually skip this question, go on to the next one.
Yeah, let's go to
There we go.
under a 1031.
This is the one we
Yeah,
want.
yeah.
All right. So because we just talked about a 1031, let's really go into depth about what it is. But first, the question, under a 1031, taxpayers must select 3 possible real estate properties within 45 days of selling the original rental property. Can these selected properties be changed before the deadline of 180 days due to some events out of the taxpayer's control, such as being delisted from the market or finding more attractive property? So 1031, what we're really looking at is we sold a property. The idea is that we don't want to pay tax on that. We want to try and defer. And that's all 1031. It's a deferment tool. But you have to pick up other properties. Now, it does have this thing, this 45 days. What's that all about? You have to pick up the replacement properties, list them out to the IRS, give an idea of what it's going to be within 45 days of having sold the original.
Pick up as in identify.
Exactly. And then we eventually close, hopefully, on all those properties within the 180 days from sale. Not 180 days from the 45, but 180 days from the original selling. So about 135 days after the 45-day mark where we had to designate all these different properties.
Right.
Now, real quick, we know we're doing a 1031. We want to defer those gains. Like we had in the previous question, we had 300,000 plus of gains. Could we have not paid tax? Well, if it had been used in business, yes, we could. 1031, you have to exchange property for property or real estate for real estate, either way, but it has to be used in the trade or business. So we can't do our personal home. Well, we didn't know exactly what the home was on the previous, but if it had been used as a rental, then we could go ahead and do a 1031. Now, once we defer that, we'll have more stringent rules on how to handle that money, and we're going to see that kind of in the next question here. However, as far as the deadline, it isn't that you must select 3 properties, it's that you get to. You can select up to 3 properties with no limitations on their value, okay, by the 45 days. And you have to have this clicked by 45 days. You cannot go 1 minute into day 46. It's very strict. Yeah. So we must have those listed out. Or alternatively, you can pick up unlimited properties, okay, but their value cannot be more than 200% or double the sales price of the relinquished property, the one you gave up. Mm-hmm. So Barley has a rental, he sells it, that's the relinquished property. Let's say he sells it for $100,000, that was the fair market value. He could bring $200,000 more into it of the replacement properties or something like that.
I could have $10,000, $20,000 properties.
Yep.
Or just trade up in value.
Exactly. But the 3, you can do up to 3 and have unlimited value or unlimited numbers,
right,
with a limit on the value. Mm-hmm. Is the way it goes. So but it's not a must. But those are your 2 options. Mm-hmm. All right. So we got the 1031. Are we allowed to change? No, it's very strict. You got to have those. Once you pick the houses, you got to stick with them, or change it before the 45 days. But after that point, no matter what happens, you're out of luck. But that's why we do recommend at least getting those 3. Or if you know you want to limit the value of how much you purchase, you can have unlimited houses. Mm-hmm. If you take that route. So you could really do either one.
Right. And so as you guys are looking at this, for those of you that have done a 1031 exchange, you know this. But for anyone that hasn't, the time to start looking for the properties is not after you sell, right? Start figuring this out before you go into the exchange. And so just to reword here, you must select 3 possible real estate properties. You don't have to, but it's likely a good idea, because what if the one you've selected and you've got your eye on, what if that falls through? And then you have 3 days to find a replacement property. That's a terrible situation to be in. Terrible situation. Then you're going to owe all that gain like that instantly, at 12:01 midnight on day 46. So it's encouraged to identify 3 properties, simply because if one falls through, you won't have to jeopardize the whole exchange.
As well, on that point, as far as trying to find properties out there, maybe they drop off, we just found out that the Senate did pass that bill. It'll go back to the House on the tax bill. You know, we still aren't there yet. But if that should pass, it's right now they're forecasting bonus depreciation, was it back to January 19th of 2025. Mm-hmm. If there's a lot of investors out there holding a lot of cash, you may see some houses fly off the market. So you'd want to make sure you have at least 3 if you're doing a 1031.
Oh boy, you didn't just mention the tax bill, did you?
Right, I did.
We're all questions. Waiting. Hold on. Well, a couple more days, we'll answer all your questions.
It's not official yet. It just passed the Senate. It's got to get through the House. They got to look at the changes. So it could get shot down, but we'll see what happens. But if it does, I think there will be probably a lot of investment out there.
Yeah, because he's right. The biggest thing of that is the retroactive statement of the law, or however you say it. It's going to go back to January 2025. So that is going to provide a lot of really big opportunities. All right, keeping it moving on. Any relevant questions we need to hit here? All right.
Oh, wait, we want to go back to 7.
Oh, that's right. Thank you.
There you go.
Yeah. So we just switched up the order a little bit. 1031 exchange. Now we can talk about.
Yeah.
After I'm taking my primary home, turning it into a rental. Great. So now we're, here, I'll just read through the fact pattern here. I'm taking my primary home, turning it into a rental for 1 to 2 years. How do taxes work if you want to do a 1031? If you want to 1031 the gain. The purchase price was 10 years ago, $430K. I lived in it for 8 years, rented it for 2 years. This is an important fact pattern, right? Kind of the timing, when did the rental activity occur, before or after we lived there, all this is very important. Sales price $1.4 million. I'm single, taking the 250 exclusion, and want a 1031 the remainder of the gain into a new property. Can this be done? Great question. Yes, it absolutely can be done. The ordering of the operations here, if you had used it as a rental prior to having it as your primary residence, you could incur what we call a period of unqualified use that would reduce your Section 121 exclusion. Looks like you're in the clear, though. You held it, or you used it as a primary residence, and you're planning on renting it out for a couple years. That's great. You're typically going to get that full Section 121 exclusion. Plus, since you turned it into a rental for 2 years, it's now considered a business asset, eligible for a 1031 exchange.
Right on.
Where do you want to go from there?
Yeah, so some of the particulars, I should say, we purchased for the original question had 400, but 400 doesn't really work because we did use it as a rental, so I went with 430. And if we did 430 or if we did 400, it doesn't matter, but the approximate depreciation for 2 years as being a rental would be about 29,000, so I went with 30,000.
So if that makes sense, so what you're saying is since it was a rental for a while, we have to take out some of that depreciation that lowers that depreciable basis.
And we go back to the adjusted basis, which was the original purchase price, 430. We're renting it. Hopefully it's a long term because I went with 27 and a half years. Gives us about 15,000 approximately each year. Now, one of the problems here is we mentioned we're going to rent it for 1 or 2 years. We're okay there. But what if we rented it out, wow, I got a great tenant, I love this deal, this arrangement, so I'm going to push it out 3 or 4 years. The problem with the 121, you have the criteria of having to own it and use it as your primary residency for 2 of the last 5 years. So if we rent too long, we're going to push outside of our 121, okay? Here we're okay with what our fact pattern here. We have 1 to 2 years. We clearly had it for 10 years. And we don't have to worry about the fact that we rented it afterwards. That's not going to impact our 121, as Brawley was talking about. We have conforming use. But if we rented it too long, we would step outside of that and we'd have to move back in order to get the conforming use.
Right.
Now we're at 430. I changed it to 430. Why? Because we have 30,000 of depreciation for those 2 years. And what that's going to do, we may want to write this one down again, get some numbers on this one. So we have the original purchase price of 430 minus depreciation for 2 years of 30,000, which gives us that adjusted basis, 400,000.
Okay.
Perfect. Now, we sold it for 1.4 million. But now fortunately it worked out really nice. We sold for 1.4. We subtract out the adjusted basis of 400. That leaves us with an even million.
Sale price minus adjusted basis, which is 400K, equals 1M gain.
Perfect. Now, we can take our 121 because again we've used it as a personal residence and owned it 2 of the last 5 years, so we can do our 121. I believe we said we were single in this one, so that'd be 250,000. If you were married, it'd be 500,000. And that's how our questioner came up with the 750,000 gain. That's how we get there. That's the gain left. Now we finally get to really what we're asking. Well, can I 1031 that? Yes, you can. We did the 121. Now we want a 1031. A couple rules about that 1031. If we want to avoid all the gain, or defer, I should say, all the gain on that 750, then we have to, number one, pick up that replacement property that we talked about in the previous question. It has to be equal to or greater than the price of the home we sold, which was 1.4. So it has to, the new property, the replacement property or properties have to equal 1.4 million or greater. And if we had any debt that we gave up, we have to pick up more debt, equal or more than that. We didn't have any mention of debt in here.
I don't think so.
Yeah, so here we'll just assume that that's how we're going to defer that full amount of the 750,000. Now, if we didn't pick up as much debt up on the replacement properties, if we didn't buy enough properties to equal 1.4 million, you're going to have a little bit of taxable gain. And as we saw earlier, what happens there, if we start to erode into our 750 here, well, we had depreciation. Again, we had depreciation of $30,000. The first $30,000 of our gain would be subject to depreciation recapture, most likely what we call 1250. So it's going to be taxed at up to 25% is probably what we'd run into here. But if we did meet those 2 criteria, picked up equal or more expensive house, picked up more or equal debt, then we are going to defer the full 750 and we're good to go.
Right. So we'd have, part of that would be the 30 for the depreciation recapture, right?
If we didn't defer the whole amount, that's correct.
Right.
And then the rest would be 720 either capital gains or whatever gets deferred. That's correct.
Or deferred.
Now, often the question we get asked, well, okay, I get these new properties coming in and these replacement properties. Well, what's the basis on those? Because remember, it has to have basis. We got to know that basis because we have to depreciate. Why do we have to depreciate? Because it has to be used in a trade or business. The property we gave up, the properties we picked up have to be used in a trade or business. So in order to get that basis, we simply take the purchase price of the replacement, which is going to, we don't know here what the purchase price of the new property would be, but we know it's going to be at least $1.4 million if we want to fully defer. And then we subtract out that deferred gain, which in our case, if we fully deferred, would be $750. That will give you your depreciation basis on the new property.
So about 700.
Yeah, and it's a lot of people hear about the carryover basis. That's true. We're still carrying over the basis in the old house, but we paid more. And when the equation works out, it's just going to be simply put, purchase price for the new home less the deferred gain is going to give you the basis on the replacement property.
Great.
So that's how we walk through that one.
Good work. Any questions on that one? Doing good?
That's
All right.
what we got. No open questions. We got 87 so far. Great job,
Sales
guys.
price 1.4, taking the exclusion.
Thank
Yeah,
you.
so that definitely can work, and we see this a lot too, guys. So just FYI. And just to reiterate this, that if you have it as a rental first, that may interfere with part of that exclusion. But if you're living there now and want to convert it to a rental, just be careful that 5-year window. Make sure you don't roll out of that 5-year window because that will reduce your exclusion as well. Good question there. Is depreciation recapture added back to the gain?
No, the recap, that's a tax you have to pay.
Yep. It's a separate tax. Essentially, your amount of accumulated depreciation, and generally speaking, will just be taxed at a little bit higher rate than the capital gain part. Capital gain taxed at 0, 15, or 20%. The depreciation recapture will be taxed at 25%. All right. And we did this one. Yeah, okay. Now we're to the boat. All right, I have a boat to donate to charity. Is it true that I can make a $5,000 donation without having a certified appraiser and claim on my taxes as a direct write-off? Well, we certainly can. We're talking about donating non-cash, essentially, assets to charity. Certainly can do that. We actually talk about donating appreciated value assets to charity a lot. That can be very beneficial. But in this case, we got a boat.
Doubt it's appreciated.
Right, we're assuming it's less than $5,000 or less value. Is it true that I can make a $5,000 donation without having a certified appraiser? Yes, that's generally true. And claim taxes as a direct write-off? Yes, that is. Yes, pretty much true. I mean, maybe not a dollar for dollar, not a direct write-off, but it is a charitable donation write-off. If you itemize your deductions, that will reduce your AGI. Couple things on this, there's these limits. I think it was 250. Is that what you said earlier?
Yeah. What you will need to do is you need to have a written acknowledgement from the charity that you donated it to. If it's over $250, which clearly this is. Likewise, if it's over $500, you have to file an IRS form 8283 to describe the asset. That's not the same thing as having an appraisal. I assume if it was over $5,000, if it's $5,001, well then yes, you'd have the appraisal, and I'm sure the appraisal, mention of that would probably go into that form 8283, but you would have to have that. So a couple little paperwork items there, but nothing crazy.
Yep. All right. Well, wrapping up here. What are the key ways? What are the ways to avoid probate? What's probate?
Probate is what happens to your estate should you pass with a will, or maybe if you don't have any will, intestate. Courts take everything over. You look a lot to state law, and 50 different states, as I tell people over and over, 50 different states, 50 different rules. No one has any idea what's going to happen in those various rules, or those various states, except somebody who's from there. It costs a lot to go through probate. It's going to eat away at your assets in the estate. It's going to take away from a lot of what your beneficiaries would otherwise be entitled to. How do we avoid that? The most common, we say it over and over, we can't stress enough, have a living trust. Living trust, you just put it in there. It takes care of business for you. Should anything happen to you, it tells your wishes, where you want these various assets to go. It bypasses the court system in that regards, that they don't have to supervise it. For the most part, so you're not running into those extra expenses. I can tell you this, anytime you die, there's enough expenses. They're going to be there, but nothing like the expenses you're going to run into in probate. I've
Right.
worked for law firms where they did a lot of probate. It's very, very costly as compared to these alternatives. So living trust is our number one. We're going to always recommend that. You know, we give out, we do a lot of living trusts here. We have a lot of free information online about them, and feel free to always come in, hit that scan code we talked about earlier, get an appointment with one of our advisors so we can get set up and look at that type of thing. But there's other items too we can use to avoid probate. Joint ownership with right of survivorship is another. That's where maybe a couple goes in, buys a house. They list it as being joint ownership with right of survivorship. If one passes, then it all goes to the other owner without probate. You don't have to have all the lawyers involved, anything like that. So it just slides in there.
That's the goal, right?
Right, exactly. Avoid the lawyers.
Not have the lawyers involved.
Trust me. Okay, and then kind of similar.
I'm involved in the front end.
Right, exactly. Yeah, we're the good. Okay, yeah, use us for the good part to avoid all of them later on.
Right.
Beneficiary designations, transfer on death, payable on death. All these are kind of getting to the same idea. Maybe you've seen in some of your accounts, they say, well, if you should pass, maybe it's a brokerage account, if you should pass, do you want it to go to one of your beneficiaries? Yeah, because it will avoid probate. So you have those kind of designations where maybe you don't have a full living trust. I recommend the trust, that'd be better. But at least some of these other things, you can express your wishes, and it will avoid probate as well. Payable on death, real estate can be done that way as well. Labels, you know, again, payable on debt or transfer on debt, either one. And it will immediately bypass probate, don't have all the expenses, gets to the other owners. And then gifting while you're living. We talked about that one as well. I think we had what we decided was $19,000 for 2025.
Right.
You can gift to one individual. If you're married, each spouse can give $19,000, so we get $38,000.
Yep.
And we have the lifetime exclusion of $13,999,000, so $13,990,000.
Right.
We'll see what happens again with the tax bill, see if we can retain that. But all these are ideas of ways that you can get gifts transferred out there without the probate use if we can. The only thing about that lifetime gift, 13.9, we probably wouldn't recommend that up front if we had any appreciated real estate. We like to give those, or any appreciated asset for that matter, because we like to have our heirs get that at death because they get that stepped up basis. Exactly, so very critical. So we want to make sure we're doing that.
Yeah.
But that's a way to avoid expensive probate.
Absolutely. Use that living trust. You don't want the court chopping up your assets and doing your, exposing your, running your dirty laundry. Right. A living trust on your passing will assume ownership of everything you have, and you take it from there.
Because the government's done so well, or running assets.
So efficient.
Yes.
Don't you want them to manage your money for you? Great work, guys. Great work. Any questions about that, please let us know, of course. We are big fans of living trust. You heard Toby talk about it a lot, right? Very important.
And there's the man. Almost 500,000 subscribers. Get in there, guys. We only have 2,000 to go.
Yeah, make sure you subscribe. Get in and subscribe. And certainly, guys, all of these topics we talked about, most of them have great videos from Toby and from Clint on all these topics. So use that as well.
And again, we have the tax and asset coming up here in September again.
Just to remind you guys again.
And maybe in Dallas in December. And again, thank you all who visited us this past week. We really appreciate it. Thank you for all the kind words you said about our program. It was great. And as always, thanks to our event team who goes all over traveling, setting these things up. They work so very hard. And it was so great to see Toby. Anybody got the chance to see him, it was just outstanding. So.
Yeah, Elliot was beaming. He was like, I got to talk to so many people, so many clients. It's so great.
And that one guy, Toby.
Yeah, and that one guy. That's right. All right, guys, make sure you scan the QR code plus the links in the chat there. Set up a session right now. Let's get the ball rolling, right? We're only halfway through 2025. We're going to get some big changes. Let's try and lock some of this stuff in, mentally and financially before before it all goes wild.
Here's your chance to get, back on that, you get your living trust taken care of.
Yep. Yeah, scan that code, get the ball rolling. Email your questions.
Yeah, that's where we're going to pick them and go through every one of those questions. And there are a lot of great questions. It's not easy to pick.
Right.
But again, thank you so much, and appreciate it.
Yeah. Thanks again, guys. Email your questions. Keep them coming. We'll see you in 2 weeks.